Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, July 9th, 2020. I'm going to start out here with the broad market. There is something I want to show you, and it's a little bit easier to do in a video format, so I'll do an update on the broad markets. I want to do an update on commodities as well. I still feel much more comfortable in the commodities arena than the equities right now. It's not just ag commodities, natural gas, some others are looking good, and even a potential short trade coming up in the commodities I'll get to in a second. Now, I may just stick to the broad markets here, get this video out to you guys, do a second one on the commodities. So let me show you what I'm looking at. First of all, the nothing new with the S&P 500. We're still bouncing around in a sideways trading range, just this little orange box right here, since the breakdown that we had back on June 11th. Man, time flies. It's been almost a month now. There's a June 11th breakdown candle, bounce, 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 going nowhere. So let's not try to make too much of that. Got to see which way it breaks. Definitive, convincing break to the upside. It would certainly be near-term bullish, but like I said, if that happens, you're going to have, if it happens anytime soon, you're going to have what we already have on the NASDAQ, and that is negative divergence. We don't have it on the S&P, as you can see down here right now. On SPY, if I zoom in a little bit here, there you go. That was not a divergent high. We were overbought, very overbought. This was a divergent high before the big drop. This would be, but you need to take out this previous high to give negative divergence. You have to have higher highs in prices, or at least an equal high, and then lower highs on the indicator. So that's one thing I'm watching, and so I just want to be clear because it's a valid question. I see that on the site from time to time. If IWM breaks over, somebody asked the other day, 145.08, is that a buy signal? Not necessarily. It is a bullish event, more about 146 I mentioned, because you have, as you can see, that blue line there is a 200-day simple moving average, and that comes in at 146.18 right now, and that's done a pretty good job of capping the advance. But this is all stuff I've covered recently, nothing new here. And again, you can box in that range. Same thing with the small caps. They had a breakdown here. There's your sell signal, that breakdown candle below this rising wedge. Follow through sell signal on the breakdown back below 145.08, which made this breakout here above that level a bear trap or false breakout. And 145 to me is a pretty significant level. That purple line goes back and just does a very, very good job of defining. It was a support shelf for a while, big trading range there, and you had a brief move down below it and right back up above it here. But again, if you just look at all the trading that's occurred there, let me get my box tool, and you can see for years, really, we're going back to 2018. You can see these trading ranges there. We tried to break above it there, or IWM did, but failed. And when it failed, it didn't just move back in and limp around. It went boom right back down to the bottom, then broke it and gave it up. So right or wrong, you can argue all day long. The technical analysis is always subjective. But to me, that's a pretty key level. And again, you have the 200-day, which has recently capped most advances. It wasn't really much of an issue here. It was at some points back here. Then we went in a trading range. When you get in a trading range, you can slop around through moving averages, things like that. You get to some more whipsaw signals. So that's it. I don't want to spend much more time on that. And then the big one is QQQ. QQQ, I don't want to call it an anomaly, but it somewhat is in the stock market. As I've mentioned, every single index out there, all of them are still well off their highs, except QQQ. The Dow, the S&P 500, the small caps, the mid caps. But QQQ, again, is not really a very diversified index. It's not nearly as diversified as the other ones as far as representation among different sectors in the economy and all that. It's just very heavily weighted, abnormally top heavy. About half of it's all tech stocks, and then you take the other remaining parts, and it's mostly Amazon. Those that don't fall in the tech category anymore, Facebook, Amazon, they put those in the communication sector. But again, they're really big tech companies. Call them what you want. So it's almost all tech anyway. So that's it. And I've showed you many times in the past. It mirrors this chart XLK, which is a tech sector ETF, almost a perfect mirror. Now, what I wanted to show you is just the unusual disparity between the Nasdaq 100 index, because again, it is it is an index, tradable index. If you have money in it, you're making money. So it's again, whether it's diversified as much as the S&P, well, it's not, but that's really what I want to show you here is the actually I wanted to compare it to. I want to compare the financials. That's what I wanted to talk about right now to tech. And so we could do this to QQQ as well, but I'm going to just use it to this sector. There's 11 sectors in the S&P 500. And let me just back up here real quick. This is one of the most important sectors, not the largest anymore. It used to be at one point in time make up a big part of the S&P 500, but tech has just continued to grow, and now it is the largest, even in the S&P 500. It's about 25% of that index. And you can see that it's severely lagging. I pointed this out the other day. We're on this 23-ish support right there. What is that? Why is that support? Well, after the bottom here, there was a big gap right here that XLF had to contend with on the way down during the meltdown, and it struggled at that gap on several occasions, pulled back, finally was able to take out the gap, fill it, but then lost it again. We're back down below there. So it's not a super solid level, but it is a level, and you can see, more importantly, most recently, that's what's been capping the pullbacks right here. So from this candle at this point, we've had numerous tags on or around that level, and so knock, knock, knock. There's what it's been doing is knocking on that level, and it's still well off its highs. And again, the financials are even if they don't have the weighting that the S&P 500 does, it's one of the most important sectors of the economy. The whole U.S. economy, the whole U.S. financial system, stock market, is built. It's a house of cards. You call it what you want, but it is a house of cards, and the Fed's right up there with it. Big financial institution. And there's no doubt about it. The banking system, we saw it in 2008. It's just it cannot. The banks cannot collapse or not function without with the U.S. economy continuing to go on. They're integrated. This economy has grown. The stock market has grown to levels that it's grown because of the banking system. So, look, is this dire right now? No. Is it a red or yellow flag? Yes. I want to point out, and I'm going to show you something. I've talked about this. Now, we can sit here all day long. I'm not the first one to say there's underperformance, but let's look at what that means. And let's go to this chart right. Okay, so the whole point of this is to point out that there's something rotten in the state of Denmark, with Denmark being the financials, or the U.S. stock market, and as far as the financials lagging. Now, I'm going to say this, and this is important. I have seen there are aberrations or temporary periods of where two asset classes or two sectors in this case disconnect, and then you have actually usually a mean reversion or reversion to the mean, where one or both they play a game of catch up. And what does that mean? Well, to have a mean reversion, it could mean outperformance. All of a sudden, whatever's ailing the financials right now, which of course I know part of it is the low interest rate environment, the fact that the Fed, because they're pretty much bailing them out. Yeah, even though the tech sector is getting aid from the Fed too, buying bonds from Apple, it's crazy, all that with their bond buying program. But the Fed has put some restrictions on banks' dividends and buybacks. That we're trying to really make sure the banks are shored up. And the bottom line is, we know a zero-rate environment is not good for the banking system. Just study the Japan banking system back in the 90s when they went to their lost decade when that started, and they went to the same thing: zero-rate policy, quantitative easing. Everything the Fed did, Japan did it, decades earlier, and you can see what happened to their banking system there. So, when a mean reversion, you could have tech stocks down, correct, and financials hold up, or maybe financials rally and tech stocks drop, tech stocks flatten out, financials rally. That's a mean reversion, kind of catching up here. But what I want to show you is, and say this too, that right now we're looking at, the disconnect. It hasn't gone on for too long, but it is worth noting because it's so pronounced. I'm measuring it out. You can see my pop-up box to the left. What I grabbed is this peak here, where they were moving roughly in line. Actually, we started to have some divergence there as well, and that was notable. We have played a game of catch-up, and there it was. It was a trade to be made on the financials, And I even pointed out some like Wells Fargo and some others at the time that were setting up, and we had a rally, but then that fizzled out. So really, we've been looking at underperformance since this point here, a pretty stark underperformance. That's about 3 months. So what I was trying to say is that sometimes you have these disconnects, and then it doesn't prove to be a problem because whatever it is ailing the financials, again, they catch up. Now, what I want to show you is the very, very, very tight correlation between XLK, the tech sector. I should have made very clear. XLF is in white. XLK, the tech sector, is in orange here. That's the colors I just happened to chose for this chart. So there's right here, financials and tech. Now what I'm going to show you, and it's a lot easier to see this if I start them at the same point. So I'm going to go into here, edit chart properties, and start at the same point. And I'm going to talk about correlations and things moving together. And so you might look at this and say, oh, well, tech stocks, have always outperformed because they have a higher growth rate. Yes, they will outperform over time in an up market because of their higher growth rate. But what you want to look at when comparing any two asset classes for a correlation is not the differential between the two lines, because they're not going to move up and down at the same price point. They're not going to drop, go up and down 5% a day, 10% a year. You want to look at the direction they're moving. And so I'm going to go back here, and we'll roll it back even farther. Let's start back here in 2002, 2001, and you can see that they're moving in lockstep. And I'm going to go through this, and I can tell you I've already done it. They moved in almost perfect lockstep, as they should. And this is a weekly chart, so you're kind of taking out some of the day-to-day volatility changes. This is a weekly chart, and you can see that they've had a almost perfect correlation until. And what we're going to do, since I started them here at the same point, what it will help to do is to roll this back like this. So just watch to the left of the screen. Here's what I want you to look at. This is how I look at this. Right here, about out to about this point here, and just pay attention to the correlation as I scroll, and you'll see that it's almost perfect, these lines, because as I come in, remember, it's starting back at the same point. These lines are going to shift, but you're going to see even these little dips. Financials dropped, tech dropped, then they were rallying, and we didn't have our first notable divergence to right here at this point. You can see it here. Let me zoom in a little bit there for you, and we're going to go back here. That's where they started to clearly diverge, and I'm not talking a day or so. You want to look for a period at least a couple months, and you can see that tech started or continued to go up, and the financials were clearly going down. When was that? Well, that was right up to this point. They'll never forget that day. I was trading. I was a full-time trader. I had recently left the brokerage business. I've been a career stockbroker up to that point, at which point I walked away from that career to pursue my passion of actively trading, and it was interesting times. And I noted, and one thing I saw the writing on the wall working, as in the most recent a bank brokerage program where I dealt with the bankers. I was an officer of the bank, talking to the mortgage folks, the bank branch managers, seeing what was going on, everything that we since heard about in the with the liar loans and crazy lending standards in the housing market bubble. It was really more of a credit bubble, but it manifested certainly in the form of the housing bubble as well. And that's it. You could see there was a tell back then. The banks were falling. The banks were moving down. In the stock market, particularly one sector, just like today, tech, was continuing to lift the market higher. And the market peaked. It was in early October. Forget the exact date, maybe October 7th. It was about the first week of October where the market peaked. And that's it. And what came after that was the greatest, they call it the Great Recession, and as you know, one of the greater bear markets in history right there. So that's that. Financials plunged. And again, it was a red flag. Now, I'm going to go through, I'm going to scroll forward in time again, and you're going to see that even once that divergence was over, the relationship returned. And you can see these lines. And again, look out to about this point here. They're moving in almost perfect lockstep. and that's how it should be. There was going to be times, and even this point here, that was at the end of the bear market right there. March 6th, I know, was the bottom of the bear market back in 2009, and you can see that's when everything bottomed right there, XLF, and then you started to move up. And again, perfect lockstep. One going up. There was a brief, very brief, but not very long period of a disconnect right there. But as I scroll forward, you can see the lines, and that's it. Let's go back to where we were and look at that. Here we go. I'll zoom out a little bit more in time. So that period, by the way, I measured. I have to go back, probably making your head spin here. The period of divergence at this point was for about 6 months up until the market topped. Measured it out before. It's right there. There it is. That's about 6 months back then. And we haven't seen, and throughout all the corrections we've had in the previous bull market, we haven't seen divergence like this since then. And as I measured before, right there, if you use that starting point, we've now been, financials have been diverging significantly for about 3 months. What's happened just over the last month, about 5 weeks here, that's just 1.1 months, very, very sharp divergence, very concerning. Again, it's not that the financials aren't going up as much as tech and the market. And really, the market, remember, the stock market's going nowhere. The stock market's going sideways. Why is this happening? And why did I pick XLK and XLF? Was it to cherry pick? Well, no. It's XLK, again, is the tech sector. And when you look at QQQ, because I think some people mistake this for the market, QQQ, although they have more than just the technology sector, even though it's top weighted, they don't have financials. The financials are less. There's a couple in there that are, and it makes up less than 1%. It's virtually, when you look at the holdings, they don't even list financial as a sector in there. And so that is, to me, a pretty, again, we'll call it a red flag. And now, can you go shorting because of that? No. You can't short at least the Qs until you have a sell signal. And as long as the Qs and tech are holding up, like I said, the stock market, although it's not going up, it hasn't gone up now for months. It peaked back here in the beginning of June. And here we are heading into the middle of July, and we're still below that point. You can't call that bearish because you're still in an uptrend. And you've been moving sideways. So, those looking at the glass half full, and they have a point here, can say, oh, well, we're correcting in time, more so in price. That's bullish. Well, it is if you break out there, and again, we're holding up there. But this isn't going to happen until tech breaks down, is what I'm trying to say. And because of that big disparity, and because it's the financials lagging, it's not the utility sector, it's not anything else that's lagging behind or diverging from the rest of the market. It is, to me, again, one of the most important probably the most important sector. I mean, obviously tech is important because of the weighting in there, but again, if there's cracks in the financial system, and I said it back then here, I said things were breaking. A lot of things broke. The bond market broke. We shorted the corporate bonds 3 times. We nailed it on 2 of those times. Sidestepped the counter trend rally, covered our short, got back in on the bounce. And so we went 2 for 3, and we would have been undoubtedly 3 for 3 with a monster hit. But that's when the Fed came in and invoked emergency charters that they hadn't used since the Great Depression back then. And that's when they came in here. And I even said it that they had to do something, that if this continued to go down, the whole financial system would break. But we started to break. There were a lot of cracks, but the Fed took a bunch of corks and they plugged up the leaks. Imagine, it's a Hoover Dam is what the stock market is, and it had a lot of cracks, and they took every finger they had, every rag and cork or whatever it is, and stuck it in those holes, and they certainly shored that up. But I'm a believer it's just a temporary fix, and we'll see. It's insane to me, knowing what's going on in the economy, knowing what's going on right now. I went over the economic indicators the other day where we're at. I listened day after day after day. More and more companies filing for Chapter 11 bankruptcy protection. If you're following the headlines, you hear it, and yet. And the whole thesis for shorting the corporate bonds, we shorted right here before they even broke down. We milked that whole first leg down right there, that run, sidestepped here, covered, jumped back in on that bounce, reshorted there, hit down to that point. I guess that was no, that was our last trade. I forget where exactly we covered again, and then we shorted one more time. But this is where the Fed stepped in somewhere here. Oh, it was right about here. It was right after we entered that last one, and decided to evoke those emergency charters where they can buy not only bonds, buy junk bonds, investment grade bonds. They're buying junk bonds that were recently downgraded. That's what they're allowed to do from investment grade status. They can even buy ETFs. This is one that they put a lot of money in, and they've been buying this one again to shore up the markets. But that's a very unnatural manipulation of the whole price discovery. Like I said, that's you Google that term, price discovery. It's the natural interaction of buyers between buyers and sellers. It's always been around throughout time, and I'm a firm believer that if you completely obscure that, and distort it, the implications are they're going to be, I think, very bad over time. In other words, okay, I get it. You had to shore up the corporate bond market, but to keep the pedal on the metal for this long and to take LQD above where it was right here, I mean, this is insane, guys. What this is, these are corporate bonds that have investment grade rating. That's anywhere from AAA is the highest. Very few companies garner a AAA rating. Government bonds do, but you go all the way down to triple B. And anything below triple B is considered a junk bond. Doesn't mean it's garbage, throw it away, but it means that that company is at a high risk of defaulting, where you may not get back some or possibly all of your principal on the bond, and they may stop the dividend payments as well. And of course, the lower you go from there, double B. So where am I going with this is we've seen default rates and bankruptcies spiking. Oh, you would have seen what would have been defaults, but again, the Fed's coming in and trying to stem that. And to me, as big as the Fed is, and as all powerful as they seem, with virtually unlimited pockets, the credit markets are just too large to permanently support those. So I think their thing was a hope and a prayer that the economy will jump back to where it was before. We're not there yet. We're not even close to where we were as far as what the economy is doing. More and more companies are folding, closing doors. We're seeing more shutdowns now. The reopenings that we had, kind of a lot of those have been reversed. And look, I'm considering another short here, and I know the Fed has the back on this market, but this is from a valuation perspective. This is insane that corporate bonds, investment grade corporates, are actually higher than they were before the whole COVID thing started. And it's just the same with these tech stocks, QQQ. There is going to be a very big mean reversion, I believe, at some point, and we'll hopefully jump on that. We need some sell signals. The market's been very resilient, the Qs, but the charts are saying at this point in time, as I've said, this is the first time that we've had clear negative divergence. What I mean, I'm talking nice separation between the peaks right here. Here's your divergence there. The PPO is distorted a lot because of this, the big drop that we had here. But there it is. So there's our divergence line right there on the PPO. There's our divergence line up above on the RSI. Divergences are not a sell signal. Back then we had just negative divergence on the RSI. We didn't even have it on the PPO, and we still got that. Of course, the S&P 500 had divergence as well, leading into that high. So, and now it does again. So that's it. The setup is there. We just need the catalyst now, or the trigger, the sell signal. And there's two ways. I've always said this. There's a couple ways. If you're going long, you buy pullbacks to support or breakouts above resistance. So if you are, bullish and looking for new highs, and maybe that's what happens. Maybe the economy does get back on track. Maybe all this recent flare-up of COVID goes away. Everybody goes back to work, and the economy starts chugging along especially with all the liquidity the Fed has injected. I have to recognize that they've injected massive amounts of liquidity into the system, and they have a lot more on standby. More that they say they're willing to do. So there's the bullish case, and you could take it there on breakout, but you need to take a breakout above resistance. It's not objective. Like I said, it's a breakout I would pass on because of these divergences. I would put very high odds that any breakout there fails. And now, on the short side, just like on longs, go long on a pullback to support. So right here, let's say you pull back to the bottom of the trading range and all those confluence of moving averages right there, that's objective for long. Whereas a short sees things in reverse if you're looking to short. You short a bounce into resistance, which this is. We are at the the top of that trading range. We're at that gap resistance. It is objective all day long to short right here with a stop somewhat above. Somewhat depends on how much room you're willing to give it in case there is a false breakout there. And otherwise, the next objective short entry is going to be on a break below that box there. Because if we take out the bottom of that trading range, that box, which is about, zoom in a little bit, you can see it here. You can see these moving averages, the 200-day simple, the 200-day exponential, and that's at the low end of it. So that's about 280, no, 290, 297, 296, somewhere in there. 295, you could even say, if you want to round it down. That would be your next objective short entry after right here. So that's it. So it depends on where you guys think the market's going. If you think it's going down and you think this is the end of the run, that the market's run out of gas here, then you short here, a fractional position, maybe a half position, and then wait till that level goes for the other half. And I'm talking for a trend trade or a multi-month swing trade for the next move down, which could be, I know the longer we stay up here off those lows, the more and more people believe that this is long behind us and we'll never see those lows again. I'm still looking at the same bear market targets I've been looking for before. This was my minimum bear market target, was just missed. Would have been a 36, or maybe I already measured out what it was, but I was looking for a move back to these highs right here from 2015, 2016. I was looking for that back here. We almost hit it. We hit it in the Dow. The Dow did hit those highs at that level. So I still think we'll get there again, and possibly even down to the bottom of that trading range over time. Now that's a long ways away. I think that would be, if we go into a multi-year bear market. For many reasons, I don't want to see that. For both, friends, family, everybody. I don't wish that upon the U.S. economy. But if it comes, we'll take it. And as of now, I'm looking pretty far ahead there with this. This is a weekly chart. Go back to the daily chart. I'm looking from here to here. So at the very least, I think it's objective short here. And you pull back down. And then maybe if you only want to hit a single, there's a 5% drop. Call it about 300. Go down to about 300. You're going to start hitting these moving averages, getting close to the bottom of the trading range. Maybe you can ride it all the way down there. But I'll tell you what I like to do is if you think you're ultimately going to get a downside break, instead of covering down at the bottom there, if and when we get down to that 300 area right here, trail down or lower your stops and allow for a bigger move. What happens is you end up giving back some profits. If we get down there, I'll tell you, it'll probably bounce once more. So the way I see this playing out, and this is a micro call, I enjoy doing these. It leads to eating crow when you make all these micro calls because they're very tough. It's easier to kind of see the bigger picture and not always game the zigs and zags. But that's what I like to try to do. So I think we'd come down here. You have that confluence of moving averages, bounce somewhere in there, get one last bounce, and then go on to break down. We could go on right on down through it. Sometimes that happens, and so if you did that with a stop above, stop may get clipped if you get a bounce there, and if we go straight down, then obviously it wouldn't, and then at that point you could just continue to ratchet your stops, as the market falls, and there's going to be other support levels along the way. This trading range back here, you can see comes in just below, if I extend that box, this one. So what'll happen, the way this works is most likely if we break the bottom of this trading range here, we'll enter this one and then go to the bottom of that, and that would act as support. Might have to better define that. There's really a range right here. That's sort of the support zone, about 275 to 280, somewhere in there. Let me wrap it up. Let me get this video out. I'm definitely not going to do the commodities now. I'll do those in a separate video, those updates. And yeah, I just wanted to talk kind of on the markets, and I wanted to point out that, like I said, that disparity between the financials and the rest of the market, particularly the tech sector. Financials are just really sitting. It's like they have sitting here with a concrete block tied to their ankle with a chain. They just can't rally now for weeks. Any rally attempt, especially over the last week or so, has been met with resistance here around that 2369 level, and so that's it. So a solid break below the recent lows here, about 2250 or so, probably going to take us down. And if that happens, that's just a bad sign for the entire stock market if there's problems with the financials. I will wrap it up here, get the video out to you guys, and then I'll follow up with another video on commodities today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.